If you're a Canadian investor looking for dividend income, you've probably come across names like VDY, XEI, XDIV, ZDV, and CDZ. They all sound similar. They all invest in Canadian dividend-paying stocks. They all pay monthly distributions. So what's actually the difference, and does it matter? The short answer is, yes, it matters enormously. Over a 20-year investment horizon, the difference between the best and worst choice on this list could mean tens of thousands of dollars, sometimes more. Today we're going to put all 5 under the microscope. We'll look at how each one selects its holdings, what you actually pay to own it, how it has performed in both good years and bad years, and how much it fell during the worst market downturns. And at the end, I'll tell you exactly which one I would choose, and why. Let's go. Before we evaluate specific ETFs, let's establish the criteria we're using. Because the criteria matter as much as the data. We're looking for 5 things. First, distribution quality. Are the distributions coming primarily from eligible dividends, real income from profitable businesses, or from return of capital and option premiums? Second, low management fees. The management expense ratio, or MER, is a guaranteed cost that compounds against you every single year. There is no equivalent guaranteed benefit to justify a high fee. Third, NAV stability and growth. A dividend ETF that pays you 4% but grows its NAV by 3% is far superior to one paying 6% with a NAV that's slowly declining. Fourth, quality screening of holdings. Does the ETF have a methodology that filters out financially weak companies, ones that might be paying unsustainable dividends? Or does it simply chase the highest yield regardless of balance sheet health? Fifth, total return over time. Not just yield. Not just NAV. The combined result, which is the only number that actually measures whether you're getting wealthier. Now let's apply these criteria to our 5 candidates. VDY, Vanguard FTSE Canadian High Dividend Yield Index ETF. Launched in November 2012, VDY is the oldest of our 5 and has the longest track record. It holds approximately 50 Canadian stocks weighted by market capitalization, with heavy exposure to the major banks, telecoms, pipelines, and utilities. The MER is 0.22%, low and competitive. The trailing 12-month yield is approximately 4.5%, the highest of our 5 candidates. VDY's historical maximum drawdown from inception is 39.2%, the smallest maximum drawdown of any ETF on our list. It also has the strongest 10-year annualized total return at approximately 13.4% per year. The weakness, the top 10 holdings represent about 70% of the entire fund. If Canadian banks have a bad decade, VDY has a bad decade. XEI, iShares S&P/TSX Composite High Dividend Index ETF. Launched in 2011, XEI is essentially VDY's closest competitor. Same MER at 0.22%. Similar yield around 4.5%. It tracks a different index, the S&P/TSX Composite High Dividend Index, which gives it somewhat more exposure to the energy sector relative to VDY. The historical maximum drawdown is deeper at 45.5%, and the 10-year annualized return comes in lower at approximately 12.3% per year. So on both risk and return metrics, XEI trails VDY slightly over the long term. Where XEI has an edge, energy sector weighting. In years when energy prices surge, like 2022, XEI can outperform. It's a marginally more diversified exposure to Canadian industry. XDIV, iShares Core MSCI Canadian Quality Dividend Index ETF. Launched in June 2017, XDIV is the newest of our 5, and in my view, the most thoughtfully designed. XDIV doesn't just screen for high yield. It applies an MSCI quality filter that evaluates every potential holding on 3 dimensions: return on equity, earnings stability, and debt-to-equity ratio. A company has to pass all 3 quality tests before it qualifies for inclusion. Why does this matter? Because without a quality filter, a high-yield ETF will inevitably end up holding companies that are paying dividends they can't actually afford, companies with deteriorating balance sheets, falling earnings, or excessive debt. Those companies eventually cut their dividends. And when they do, it hurts. Here's a real example. BCE, Bell Canada Enterprises, was for years one of the most popular high-dividend holdings among Canadian investors. Massive company. Reliable-looking yield. But the balance sheet was deteriorating. The payout ratio was unsustainable. In 2025, BCE cut its dividend by 56%. ETFs without quality filters held BCE right through that cut. XDIV's methodology was designed to filter out exactly this type of situation. The MER is 0.12%, the lowest of our 5 candidates, less than half the cost of VDY, and nearly 1/6 the cost of CDZ. ZDV, BMO Canadian Dividend ETF. Launched in 2011, ZDV uses BMO's proprietary scoring system to select dividend payers across multiple sectors. Its defining characteristic is deliberate sector diversification. It consciously reduces concentration in financials relative to VDY and XDIV. The MER is 0.39%, higher than VDY and XDIV, but lower than CDZ. The 5-year returns trail VDY and XDIV. The primary reason to choose ZDV over VDY or XDIV is if you specifically want less exposure to Canadian banks, perhaps because you already hold bank stocks directly, or because you believe the financial sector is overvalued. CDZ, iShares S&P/TSX Canadian Dividend Aristocrats Index ETF. Launched in 2006, CDZ is the oldest ETF on our list and has the most rigorous philosophical approach to dividend quality. To qualify for inclusion, a company must have increased its dividend for at least 5 consecutive years. Think about what that requirement filters out. A company cannot maintain 5 straight years of dividend growth if it has a deteriorating balance sheet. The Dividend Aristocrats methodology is, in theory, the most demanding quality screen available. The problem is the cost. The MER is 0.67%, nearly 6 times more expensive than XDIV. On a $300,000 portfolio held for 20 years, the fee difference alone compounds to tens of thousands of dollars. And the data doesn't justify the premium. CDZ's 5-year annualized return is the lowest of our group. Let me put the key metrics on screen so you can see them all at once. A few things jump out immediately. VDY has the best combination of yield, drawdown protection, and long-term return. XDIV has the lowest cost and strongest quality screening. CDZ has the highest cost and the weakest returns despite its premium philosophy. Now let's look at how these ETFs actually behave during real market conditions from 2020 through 2024. In 2020, the COVID crash hit all 5 ETFs. VDY held up the best, falling only 1.3% for the full year including dividends. XEI and XDIV both fell about 7.6%. ZDV dropped 3.5%. CDZ fell 3%. VDY's concentration in Canadian banks, heavily regulated, government-backstopped institutions, provided relative stability in the most acute phase of the crisis. In 2021, everything bounced back strongly. VDY led with 36.8%. XEI followed at 35.9%. XDIV returned 33.3%. ZDV was at 28.8%. CDZ came last at 25.1%. In 2022, the Bank of Canada raised rates aggressively. But Canadian dividend ETFs held up remarkably well. VDY was essentially flat at negative 0.2%. XEI was positive 0.4%. XDIV positive 0.5%. ZDV negative 1.7%. CDZ was the weakest at negative 4.2%. Banks benefited from higher net interest margins. Energy companies generated record cash flows. These 2 sectors dominate Canadian dividend ETFs, and both performed well in 2022. Then in 2023 and 2024, XDIV pulled ahead. In 2023, XDIV returned 11.96%, the best of the group. In 2024, XDIV returned 23.03%, again leading the pack. This 2-year outperformance is exactly what the quality screen was designed to deliver. I want to spend a moment on CDZ's fee, because I think many investors underestimate how much it matters over time. The difference between XDIV's MER of 0.12% and CDZ's 0.67% is 0.55 percentage points per year. That sounds trivial. It isn't. On a $200,000 portfolio, that fee difference costs you approximately $1,100 in the first year alone. But because you're losing that money instead of compounding it, the cumulative impact over 20 years is enormous. An investor who chose XDIV over CDZ 20 years ago would, on a large enough portfolio, be looking at a difference of potentially $40,000 to $60,000, purely from fees, even before accounting for any return differential. The Dividend Aristocrats concept is sound. But XDIV delivers comparable quality protection at a fraction of the cost. For most investors, the fee premium for CDZ is simply not justified. Before I give my final recommendation, there's one risk that applies to all 5 of these ETFs, and it's important to be honest about it. All 5 are heavily concentrated in 2 sectors, financials and energy. Combined, these 2 sectors typically represent 60 to 80% of each fund's holdings. This is not unique to any one ETF, it's a characteristic of the Canadian equity market itself. Canada's largest, most profitable, highest dividend-paying companies happen to be banks and energy producers. What this means for you, if you already hold Canadian bank stocks directly, or if you hold other ETFs with significant Canadian bank exposure, buying VDY or XDIV means you are doubling down on the same sector risk. You are not diversifying. You are concentrating. And if there were ever a systemic crisis affecting Canadian financial institutions, unlikely, but not impossible, all 5 of these ETFs would decline significantly and simultaneously. This is a structural characteristic to be aware of, not necessarily a reason to avoid these ETFs, but absolutely a reason to ensure your overall portfolio has geographic and sector diversification beyond just these products. So what's the verdict? If I had to choose one ETF from this list for long-term core dividend income, I would choose XDIV. The lowest cost. The strongest quality screen. Consistently strong recent performance. Growing assets under management as sophisticated investors recognize its value. And a methodology specifically designed to avoid the kind of dividend trap that caught BCE investors off guard in 2025. If maximum current yield is the priority, VDY is the better choice, and its long-term track record is genuinely excellent. If you want more sector diversification away from Canadian banks, ZDV deserves consideration, but you're paying extra for that benefit. CDZ has a compelling philosophy but charges too much for what it delivers. XEI is solid but trails VDY on both return and drawdown protection over the long run. In our next video, we're going to talk about something that can quietly add as much value as choosing the right ETF in the first place: tax placement. Which accounts should hold which ETFs, and why getting this wrong can cost you thousands of dollars every year. Subscribe so you don't miss it. See you next time. This video is for educational purposes only and does not constitute investment advice. Please consult a licensed financial advisor before making any investment decisions.